Here we have the PTF trade of the month for October 2018. Today we're going to look at a trade that closed at the beginning of October for Cooper Tire and Rubber Company on the New York Stock Exchange versus the Goodyear Tire and Rubber Company GT on NASDAQ. We had an entry signal on the 10th of August 2018 to buy 410 shares of GT and sell short 333 shares at CTB. There are the prices, and there you have an example of the entry. So we would now undertake our detailed analysis of this trade to figure out whether this is something we want to trade or not. So the first thing I would do is take a quick look at the fundamentals. So if you go into Pair Trade Finder Pro Fundamentals tab, you've got Cooper Tire and Rubber versus Goodyear Tire. Let's first go to the description. Let's see what kind of businesses they're in. We see that CTR designs, manufactures, and markets replacement tires all over the world. Okay, Goodyear Tire and Rubber, it manufactures, distributes, and sells tires and related products and services worldwide. If you read the two detailed descriptions, they're very, very similar companies. The only difference is that Goodyear tends to have, it has 1,000 retail outlets, so they have a retail business, whereas Cooper is mainly through independent tire dealers, wholesale distributors. So we take a quick look at the financials. I like to look for market cap neutrality and beta neutrality. You can't always find them, but you might want to make compensations otherwise. This we can see the market cap is about 1.7 billion for Cooper. The market cap on Goodyear is about 5 billion. It's about a 3-to-1 size difference. To me, what's important is that they're trading in a similar range in the market that would be impacted by macroeconomic events in a similar fashion, and I think those market caps are close enough that they would be. Here you see a beta of 0.89, and Goodyear has got a 1.76. So that's one is half the other. That's something you might want to take into account when you are calculating your share ratio when you go dollar neutral. However, if we look at some of the financial figures on these, if we go to statistics, probably the beta, because again these businesses are so similar, the beta differential is likely coming through the fact that Goodyear, if we look at it, total debt to equity is 131, and total debt to equity on Cooper is is about 29. So one is much more levered than the other, and that would tend to magnify the market premium. So that might explain the beta discrepancy, something to keep in mind. What I would point out here is that they're valued very similarly. If we step above the financing structure, enterprise value to EBITDA of 4.5 for Cooper, enterprise value to EBITDA of 5.3 for Goodyear. Again, EV to revenue, grosser figure 0.6 for Cooper and 0.7 for Goodyear. So with that, we're very convinced these are fundamentally similar companies. And then we move on to the next step, which is to check out how they backtested in the past. And to do that, we've gone to the historic backtest. And we see here that over 3 years there were 11 trades. Nice, smooth, upwardly sloping equity curve. Average correlation is 71.5%. Co-integration is a bit low, 0.73. May likely not be stationary. That's over the entire 3-year period. Compound annual growth rate over that period was 14.3%, max drawdown of 8, profit factor of 12.7, gross profit of 6,000, commissions of about 15% of gross profit, average net profit of trade about $450, and 81% of them were winners, and the average number of days in trade are about 24 days in trade. So on the back test, looks brilliant. So let's go to relative performance graph. We always like to see whether we are seeing these come together and diverge, then come together, diverge, then come together, diverge, come together. That's important, and you can see that happening throughout the last year. What you can see in the last 2 weeks or so is a massive divergence. Now that's not the trade we're taking. That's something that's happened recently, and we're looking at the trade before that. So if I review this chart, it looks to me like they are correlated and co-integrated well. So that checks out. So then we would go to check news. So if we remember, the signal was generated on August 10th. to enter. So if we check news on Goodyear, July 27th was when they reported their second quarter, first half results. Then there was nothing till September 6th. So there was no market moving news from Goodyear in that time period. And if we go to Cooper Tire, on August 6th, they announced results, and they were broadly in line with expectations. They lowered their expectations for the second half very slightly, but reiterated their 3 to 5 year estimates. So, and not only that, this had 4 days to work through on the market. So we don't think that necessarily was the source of the signal, which, as I say, was generated on the 10th of August. So we would consider the news review clear, and that this looks like a liquidity generated signal. Also important to note, we're looking at the earnings date. So this was right before, 3-4 days before the signal, and the other one was about 10 days before the signal. So we know we're clear for a 25-day trade. There aren't going to be any more earnings announcements in that period. Then we just have to check dividends. So if we go quickly back to the fundamentals, we should see dividend dates. So December, that would make November, October, September 3rd. That gives us at least 6 weeks, and then the same here, even more. We would have almost 3 months ahead of the dividends. So we're clear on news and dividends, which would clear this trade to go to a detailed statistical arbitrage analysis from the pair charts. So let's do that. Let's go to the pair charts, and what can we see? Again, we're talking about this signal here on 13th. It's on the 10th of August, and that was just over 2 standard deviations. And then the exit came on the 2nd of October when it came back to 0, and we can see it over here on the ratio chart. We don't have a ratio breakout, and it was a nice return to the mean. However, if we look at the RSI chart, the entry happened at a RSI of 60. Now that's not an extreme. That probably would have caused me, when I saw the signal, to hesitate a bit and maybe wait a little longer to see whether the RSI might go to an extreme and whether this ratio might diverge further. And if you had done that and you'd waited 3-4 trading days, a bit more, about 8-9 trading days, you would have seen that it did diverge further. And it did reach a 70, an extreme reading on the RSI. So that can sometimes be a guide there on the RSI to maybe wait a little bit longer. And so if you had gone in, the exit was, as I say, on 2nd October, and it was at a very serious extreme. It was at 15 on the RSI, so that would have been a great indication to get out. Do we see any divergence? I can read divergence here. So we've got a rising ratio line, but if you look at the RSI line, it's sloping downwards. The highs are sloping downwards. That says to me there's divergence, so that's a very positive signal that there's a potential turnaround in the ratio trend coming about. The only thing I look at that I don't like much here is that the correlation has broken down at the time of the signal. From about 80%, 90% where it's been happily sitting for about the last year, and it's broken down to about 50 at the time of the signal. Now that's consistent with previous breakdowns that led to entry signals in the past. You can see one back in 2017. So it wouldn't concern me overly much, because these correlation breakdowns do happen when signals are generated. What is important is over the last year it has been highly correlated. So remember, we don't see this bit because that's in the future. We're looking at this point in time. So on prima facie on the charts, this looks like a great trade, and I also like the divergence, which would say to me that there's a probable ratio trend turnaround coming. The only thing we haven't checked is the volatility. Let me just go to that. Sorry. So we're going to charts. Let's just change the correlation chart for volatility. And okay, let's redo this. And our volatility chart, so here's the signal. When it happened, it was at 2.61, in line with past peak of volatility. and the pair has ranged from about 1.4 all the way to about 2.9, and this signal happened at 2.6. A little bit higher. You might want to go a slightly smaller position size, maybe 3/4 position, because you're over 2%. That's up to you and what it is that you decide with respect to your trading plan. So the summary on balance of the pair charts looks like a good trade. Might have waited a few days because the entry is not at an extreme, but you also have divergence which suggests that it's probably a reasonably good time to get in. So that's the result of the pair chart analysis. What did it end up doing? Well, we can see the exit happened 53 days later, which was almost double what we predicted the time period would be. On 18th of, the exit should be on 2nd of October, and what happened? We had a long leg loss of 311.60 and a short leg win of over 1,018.98. So the total gross profit was $707 after commissions, estimated commissions and slippage. That's $609 in 53 calendar days. That was 61% on nominal leg value and a 15% return on CFD margin. So that's the trade of the month for October. Cooper Tire and Rubber versus Goodyear Tire and Rubber. Happy trading, everyone.